The Backdoor Roth IRA is an educational strategy that allows high earners to contribute to a Roth IRA even if their modified adjusted gross income exceeds the limits set by the IRS. Under standard tax guidelines, direct contributions to a Roth account are phased out once your income reaches a certain threshold. However, by utilizing a specific two-step process, you can build tax-free retirement savings regardless of how much money you earn. This strategy is not a loophole or an evasion technique. Rather, it is a combination of two IRS-approved features: non-deductible traditional IRA contributions and Roth conversions. Because this process involves strict tax rules and coordination between different accounts, understanding the mechanics, potential tax traps, and required reporting forms is essential. This overview explains how the backdoor Roth process works, the impact of existing pre-tax IRA balances, and how to execute this strategy while remaining compliant. First, let us examine the two-step mechanics of the backdoor Roth IRA process. The first step involves opening a traditional IRA and making a non-deductible contribution up to the annual limit. You choose a non-deductible contribution because your modified adjusted gross income is above the phase-out limits, meaning you cannot claim a tax deduction. Once the contribution is made, the money sits in the traditional IRA as after-tax basis. It has already been taxed, so you do not receive a tax break today. Anyone with earned income can make this contribution, as the IRS does not limit traditional IRA contributions based on MAGI. The second step is the Roth conversion. You instruct your custodian to move the funds from your traditional IRA into your Roth IRA. Because the contribution was non-deductible, you have already paid taxes on that principal. If the conversion is executed quickly, before the money has time to earn interest or investment growth, the conversion is tax-free. The entire balance moves into the Roth IRA, where it can grow tax-free and be withdrawn tax-free in retirement, achieving the same tax status as a direct Roth contribution. This conversion can be completed regardless of your income level, which is a major advantage for high-income earners who want to build tax-free wealth. It is important to execute this conversion in a timely manner. If the funds sit in the traditional IRA and earn investment growth, that growth is taxable upon conversion. For instance, if your contribution earns interest before you convert it, you will pay ordinary income tax on that gain when you move the funds. To keep the process simple, coordinate with your brokerage to execute the conversion immediately after the contribution clears. This minimizes taxable earnings. Completing the steps in quick succession reduces the likelihood of small interest payments, creating taxable events that complicate your tax return. Second, we must examine the most significant trap associated with this strategy: the IRS pro rata rule. Many savers mistakenly believe they can isolate their new non-deductible contribution and convert only that specific money. However, the IRS treats all your traditional, SV, and simple IRAs as a single combined account when calculating conversion taxes. If you have existing pre-tax money in any traditional IRA, you cannot convert only your post-tax funds. This is a common error that catches self-directed savers by surprise, as they assume each account is walled off. The IRS aggregate rule applies to all non-Roth individual accounts. The IRS calculates the taxability of your conversion based on the ratio of after-tax money to pre-tax money across all accounts. For example, if you have $90,000 of pre-tax money in an old rollover IRA and make a $10,000 non-deductible contribution, your total balance is $100,000. In this scenario, only 10% of your total balance is after-tax basis. If you convert $10,000, only 10% is tax-free. This ratio applies to any conversion you make, making it impossible to cherry-pick post-tax dollars while leaving pre-tax dollars behind. The remaining 90% of the converted funds will be subject to ordinary income tax. This pro rata rule can make the backdoor Roth strategy highly inefficient for individuals who hold large pre-tax balances in other IRA accounts. To avoid this trap, some savers roll their pre-tax IRA balances into an active employer-provided 401k plan. The pro rata calculation does not include funds held in active employer-backed 401k accounts, allowing you to clear your IRA balances and execute a tax-free backdoor conversion. This reverse rollover strategy is an effective way to clear the path for conversions. Finally, We must outline the reporting requirements and tax forms you must file to document this strategy. When you make a non-deductible contribution, you must report it to the IRS on Form 8606. This form tracks your after-tax basis from year to year. When you execute the conversion, your broker will issue a Form 1099-R in the following calendar year, documenting the distribution from the traditional IRA. You must report this on your tax return and use Form 8606 to show the converted funds were after-tax basis, even if the net tax impact is zero. Filing these forms correctly is essential to avoid double taxation. If you fail to file Form 8606, the IRS will assume your traditional IRA contributions were pre-tax and tax the entire conversion. Additionally, make sure tax software is configured correctly to handle the backdoor Roth process. Many self-directed filers make the mistake of entering the contribution and conversion in a way that suggests a standard contribution, triggering automated tax notices. Reviewing these inputs can prevent unnecessary correspondence audits from the IRS, which are time-consuming to resolve after your return has been processed. In summary, the Backdoor Roth IRA is an effective educational strategy that allows high earners to access the benefits of tax-free growth and tax-free withdrawals. However, executing it requires careful management of existing IRA balances to avoid the pro rata rule and diligent record-keeping during tax season. By understanding these steps and verifying your accounts, you can build a robust savings portfolio. Seeking the guidance of a qualified tax professional is a smart step when executing a conversion to ensure compliance with all active tax regulations. Keeping detailed records builds a clear history of your account's cost basis for future reference. Retirement Roadbook helps you navigate 401k plans, IRA rules, compound interest, withdrawal strategies, and common retirement planning mistakes. The channel turns complex financial regulations into clear, practical education so you can build a more secure future with confidence. This video is general retirement planning education, not personal financial, tax, or investment advice. Consult a licensed professional before making any financial decisions.